Hello and welcome to Portfolio Matters Weekly Update, week 77. Now, as warned last week, all three of us were on holiday this week, so this is a brief update recorded on Sunday, the 3rd of July. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, news this week. Well, on Wednesday, the Bank of England warned that British inflation would be higher for longer than in other countries, and that it was committed to bringing it down even if it meant further pain for households. And Andrew Bailey, the governor of Bank of England, reserved the right to raise interest rates by 0.5% at any MPC meeting, although he did not commit to further rate rises. Elsewhere, the Bank of International Settlements warned that the world faces structurally higher inflation unless central banks act more decisively. And Britain is an example where we are failing to act decisively. The inflation is, I believe, 9.1%, and the interest rate are 1.25%. We're a long way behind the Taylor rule. And in crypto land, another crypto lender, Voyager Digital, has suspended withdrawals. And as you'll see as we go through, the crypto space is slowly deflating. Okay, some economic data out this week. Well, we had Eurozone inflation numbers, and the headline number, CPI, beat expectations and was very hot. So expectations were for 8.3%. It actually came in at 8.6%, up from 8.1% in May. So the headline number shows strong inflationary pressures still building, but the core number actually missed. So the core number was expected at 3.9%, and it came in at 3.7%, down on May. And elsewhere, as we go through the charts, you'll see there are signs that inflation may be peaking. In the UK, we had the nationwide house price index, which continues strong. So year on year, house prices grew at 10.7%, which hit our expectations. Month on month, they missed slightly, but still grew. They were up 0.3% month on month. That is despite record increases in mortgage rates, although mortgage rates in absolute terms remain quite low. Net mortgage lending for May massively beat expectations. So the UK housing market remains resilient. Now, moving on to the US, pending US home sales beat expectations. So they're expected to fall by 4.5% month on month. And they actually grew by 0.7%. The year on year number seems incompatible with the month on month data. In the year on year, home sales actually fell by 13.6%, which missed expectations. So the month-on-month numbers beat expectations, year-on-year missed. The Case-Shiller house price index beat expectations. Year-on-year, house prices grew 21.2% in the year to April. And inflation in the US, the Fed's preferred inflation measure, PCE, which is personal consumption expenditure, rose by 6.3% in the year to May, and that missed expectations. It was unchanged from April. So signs that personal consumption expenditure inflation may be peaking, and the core number also missed expectations. Now, the big numbers in the US and for markets this week were the ISM manufacturing PMIs, which were disappointing. And we'll go through some charts, but they portrayed a manufacturing sector which continues to slow. And employment in particular actually fell. So those are harbingers of a possible recession and led to a sell-off in equity markets. And we also had some quarterly numbers. So reminder, US GDP growth for Q1 was negative. So the annualized quarter-on-quarter growth in Q1 was minus 1.6%, and that has been revised down from the previous number of 1.5%. US corporate profit growth quarter-on-quarter annualized for Q1 was minus 4.9%. That missed expectations. And UK GDP growth quarter-on-quarter, and this is quarter-on-quarter growth, not annualized, was plus 0.8%, was plus 0.8%, which hit expectations. Okay, moving on to some charts. So the UK housing market remains astonishingly resilient. So lending in May was the strongest it's been in over 6 months, despite a slowing economy, a cost of living crisis, and rising mortgage rates. I have been predicting a slowdown in the housing market in both the UK and the US, and so far I've been wrong. This is EU inflation. Headline inflation beat expectations and shows no sign of slowing. But core inflation actually ticks down. But you'll notice that 1 month's data does not necessarily mean a change in the trend. We have had other down months before the uptrend continues. So we'll just have to wait and see whether inflation has peaked. EU consumer confidence continues to deteriorate and is now pretty much close to its all-time lows. But the EU unemployment rate actually beat expectations and is the lowest it's been since the start of the Eurozone. So that paints a picture of actually strong employment and a resilient economy in the Eurozone. These are US durable goods orders month on month, and in May, they were strong, beating expectations, up 0.7% month on month. Pending home sales for May, again resilient. And we know that mortgage rates have really shot up in the US, but people still want to buy houses. Although the year-on-year numbers show strong declines. This is Case-Shiller House Price Index. Continues to show inflation well above 20% and not yet falling. And month on month, still growing, 2.3% month on month. The US housing market remains very strong. US personal consumption expenditure inflation is down from its peak, which is reassuring. Are we seeing a peak in inflation in the US? And the core number came off quite sharply. Moving on to some charts from the ISM manufacturing survey, which showed the prices paid is falling. Now we've had this before, and inflation has then surged higher again. So 1 month, a couple of months data do not necessarily mean the trend has changed, but currently it looks like we have a few numbers which appear to show inflation is peaking, and the bond market strengthened substantially this week as the bond market is beginning to believe in a recession, and hence that rates will not have to rise as high as they'd previously assumed. New orders fell below 50, so the new orders index is indicating that orders are falling. Employment is also below 50. So the survey is showing that manufacturers are actually cutting jobs now. Although initial jobless claims are stable and continuing jobless claims are also stable. So in summary, what we've learned this week is that in the EU, headline inflation continues to rise, beating expectations. But elsewhere, there are signs that inflation may be peaking. In the US, personal consumption expenditure inflation and core PCE both fell. And in the EU, core CPI inflation fell as well. So the bond market seems to be believing that inflation may be peaking. Now, in the UK, obviously, the Bank of England has said that inflation is likely to remain higher for longer, but even UK bond yields fell this week. Mystifyingly, the housing markets on both sides of the Atlantic continue to be strong, and that is good for the economy. But I question how long that can last in the face of a cost of living crisis and rising interest rates on both sides of the Atlantic. And the ISM manufacturing survey in the US for June was uniformly negative and shows a slowing manufacturing sector. Okay, moving on to one chart. And this is the nowcast from the Atlanta Fed for Q2 growth in the US. And we've covered this in previous weeks. Well, it's just fallen off a cliff. A few weeks ago, it was forecasting GDP growth of about 0.9% in Q2. It's now forecasting minus 2.1%. Now, as you saw earlier, growth in Q1 was negative, and the definition of a recession is 2 consecutive quarters of negative GDP growth. So, is the US already in recession? Okay, on to Inflation Watch. And we had new data for the EU this month, as I've just described. The headline CPI number was 8.6% for June, which was up substantially, but the core number actually fell by 0.1%. And in Germany, we have the June headline number, and that was also down. So the Eurozone as a whole saw strong rises in inflation in June, but in Germany, inflation fell. So something to watch. Now, the markets appear to be pricing in a big energy crisis in the Eurozone in the coming winter. The yellow line is German one-year ahead power prices, and they continue to rise back towards their highs of December last, as Russia continues to constrict gas exports to the EU. And onto Recession Watch. Well, this is global consumer confidence, and it is pretty much back to its lows of the great financial crisis. It is much lower than its pandemic lows. And currently markets are very optimistic about corporate earnings growth, but this chart suggests they shouldn't be. The tan line is global PMIs, shifted forwards by 9 months, and the green line is global earnings surprises. And as you can see, earnings surprises tend to follow the PMI with a 9-month lag, and PMIs have dropped sharply, which suggests if that relationship were to hold, corporate earnings will have a very tough second half of the year. And that is what I am expecting. I'm expecting a big slowdown in corporate earnings in the second half of the year. And hence, I'm expecting further falls in the stock market. And on to other charts. Now, this is the Chicago Fed Financial Conditions Index, which we will be aiming to cover on a fairly regular basis. And you'll see that conditions are tightening sharply, and they're now above zero, which only happens in crises, essentially. And that matters because when financial conditions are tight, investors require higher risk premium. So you can see here, there is a strong correlation between the financial conditions index and the dividend yield. As the financial conditions index rises, so stocks have to sell off so that their yield rises. And moving on to equity markets. Well, equity markets continued their bounce of last week. The all shares up 1.2%. The S&P 500 was up 0.8%. The NASDAQ continued to drift off, down 0.9%. Bitcoin down 8.4%, down 58.8% on the year. And regular viewers will know I consider Bitcoin to be a speculation rather than an investment, and you only buy speculations when they're going up. If you own Bitcoin, I suggest it's time to consider whether to get out. Sterling had a poor week, down 1.3%. The dollar was strong, again up 0.8% on the week, up almost 10% on the year. Now, this is a comparison of different bear markets in history, and you can see there's a very wide range of outcomes, and bear markets can last a very long time. The 1973 to 74 bear market lasted well over a year. So I wouldn't be rushing to buy. I think we are going to see an earnings recession in the second half and further falls. So since the great financial crisis, central banks have been targeting the wealth effect. They have cut interest rates to support the equity markets in the belief that as consumers' savings rise with equities, so they will feel wealthier and they will spend some of that extra wealth supporting demand. Well, this year, equity market losses are the equivalent of 46% of US GDP. So, will consumers now cut back? Will the wealth effect go into reverse and contribute to a recession in the second half? Now, I think this is an amazing chart. This is corporate profit margins versus consumer sentiment. Now, so far, profit margins have held up amazingly well, while consumer sentiment has totally collapsed. If the historic correlation between the two were to hold, then you would expect corporate profit margins to start coming down. This is Bitcoin, which is continuing to come down sharply. It's now below 20,000. Its peak was last year above 65,000. And the CNN Fear and Greed Index is off its lows, but still registering extreme fear. Okay, on to commodities. So energy to commodities bucked the trend and were up. So Brent was up 1.3%, WTI 3.6%. Dutch natural gas futures continue to rise, up 10.8% on the week, 110% year to date. US natural gas futures, however, continued to fall. There's been a strong correction in the US following the problems at one of the LNG liquefaction facilities, which will restrict exports from the US for the next 3 months. Coal fell 2%, but is still up 130% year to date. Uranium bounced back, up 6.8% on the week and 17% year to date. Now, I'm afraid we continue to not have inventory data from the EIA as they are having problems. We now had no data for 2 weeks. The Baker Hughes rig count, they seem to have revised their numbers. So their latest number is 595 rigs at work in the US, and that is a change from the 584 we reported last week, although they are now reporting there are 594 rigs at work last week. But if we use the numbers we reported last week, that's a rise of 11 and a rise of 113 year to date. Okay, this is crude, and as you see as you'll see as we go through the industrial commodities, all the industrial commodities are having a really hard time. Crude oil has been resilient. It's come off from its peak, but the bull market in crude seems to remain intact. Now, I've had a lot of debate on the Discord about what happens to oil demand during recessions. And this chart shows that diesel demand can fall by up to 15% during recessions. And this is diesel over the last 20 years. And you'll see that even in the relatively shallow 2002 recession, diesel demand fell by over 10%. And the currently high oil prices are already causing demand destruction. So the green line is US oil demand for this year, and the red dotted line is 2018, the blue dotted line is 2019, and you'll see that demand is running well below those years. So that suggests that oil prices can't keep on rising because they're already causing demand destruction. This is Dutch natural gas futures, and this is a worrying chart, grinding higher. US natural gas come off sharply. Coal still stable at very high levels. Uranium bouncing back. Okay, on to industrial commodities, and generally a very poor week for industrial commodities. Aluminium down 1.4%. Cobalt was down 9.6%, although the pricing there seems to be quite erratic. Copper was down 4.1% on the week, and Dr. Copper is diagnosing a slowing global economy. Nickel down 9.2%. Tin down 8.3% on the week. Zinc down 12.7%. So industrial commodities are coming off. They're showing a slowing world economy and slowing demand for industrial metals. This is aluminium. It's now down on the year. Cobalt has come off sharply. Copper falling to new lows for the year. And if we look at it on a longer term chart, you see that potentially it has a lot further to fall if it were to fall back to 2018 or 19 prices. Chromium remains resilient for now. Iron ore drifting off. Lithium stable at its highs. Neodymium stable as well. Nickel is coming right off. Tin has fallen sharply and substantially down on the year, although if you look at the long-term chart, you'll see there's been this tremendous spike, which is now unraveling. Ferrovanadium, the recent surge has completely unwound. Zinc falling. Onto precious metals. Another disappointing week. Gold down 0.7%, silver down 5.3%, platinum down 2.9%, palladium bucked the trend and was up 4.6%. This is gold, which is priced in US dollars. Reminder that the dollar index has risen 10% this year. So in other currencies, gold has actually done much better. Silver had a terrible week and is now substantially down on the year. And if silver was to return to its 2018 levels, there's still some way to go. Platinum hit new lows for the year. Rhodium was stable. Palladium ticked up a little bit. Going on to yields. Now, bonds recovered strongly from their recent sell-off. Even UK bonds had a good week. So the 2-year yield fell by 26 basis points and the 50-year yield fell by 12 basis points. That is despite Andrew Bailey saying that UK inflation was likely to be higher and more persistent than in other countries. In the periphery of the Eurozone, yields fell. So the ECB's recent emergency meeting in which they discussed new anti-fragmentation measures and instruments seems to have reassured the markets. This is the Italian 10-year, which has come down sharply from recent peaks. There's the Greek, there's UK, and the US. This is the seasonality chart, and we're now entering July and choppy waters before potentially difficult final quarter. So concluding comments, what have we learned this week? Well, industrial commodities and bond markets appear to be pricing in an increased probability of recession. Crypto land seems to be slowly imploding, and there's an open question of whether losses incurred in crypto space will have knock-on effects in traditional markets. Will people who have lost money in crypto then need to sell their traditional assets to meet liabilities? And finally, on to my own activity. Well, I was away all week, so I did no buys, no sales, and my portfolio was up 1.5%. The all share was up 1.2%. So I did okay. I was up 0.3% more than the all share, and I'm having a very good year relative to the all share. Now, I saw this tweet from Andreas Steno Larsen during the week, and I thought it was extremely good advice. We are still in a rising interest rate environment, and there are no mainstream financial assets that like rising interest rates. Therefore, your asset allocation decision is really easy. You should be in cash. Regular viewers will know I've started a small position in the 2071 gilt, and it bounced back from its lows. Now, the strong rises in bonds this week look to me to be overdone, and I will be watching this in the next few weeks rather than adding to it yet. UK inflation has not yet peaked, so there is still the possibility that gilt yields could head substantially higher. My big purchase of 2 weeks ago was the iShares US Treasury 1 to 3 year bond ETF, which I bought mainly to move money out of sterling into US dollars. And that has been a fortuitous move because bond yields have fallen, which has been good for the ETF, and the dollar has risen. So I bought it about 104.5 and it's now at 107.4. And that has been responsible for the majority of my returns this week. And I want to talk about one stock, Petrometad had an update which was far from reassuring. Reminder, Petrometad has development assets in Mongolia, which it had been struggling to develop. And the latest update showed more delays and also admitted to access problems that they had previously not declared. So the shares have sold off. Now, if they can develop the Heron 1 well, there's plenty of upside here. But I'm growing frustrated with the lack of transparency and action from the current executive team. So it's clear I've clearly been wrong in holding on to it. Okay, that's it. Thank you all for watching to the end. Normal service will be resumed this Friday when Richard and I will be doing a full weekly. In the meantime, it's goodbye for me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.